Chapter 2, Reporting Investing and Financing Results on the Balance Sheet. The first learning objective is to identify financial effects of common financing and investing activities. When you start a business, you need money and other resources in order to get that business going. What we mean by financing and investing activities is you get your financing either by taking loans from banks or other places, and you invest in assets. You buy or purchase assets or build assets in order for you to be able to provide your good or your service in your business. So this is a good time to review the balance sheet equation and the definitions that go with it, because we'll be looking at the concepts in this chapter through the framework of the balance sheet equation. Assets equal liabilities plus stockholders' equity. Now, an asset is something that is owned by the business that will generate future economic benefit. By economic benefit, we mean it'll help us generate net income, it'll help us generate cash flow, something like that. Liabilities are amounts that are presently owed by the business to its creditors. Like we take out loans from banks, we issue bonds, which we'll learn about later on in the course, that type of thing. Stockholders' equity is the amount invested and reinvested in terms of profits that get reinvested in the company, by its shareholders. The company can invest in assets in one of two ways. It can either take out debt, i.e. loans, or it can bring in cash from its owners and use that to invest in assets. So through the process of accounting, a company always documents its activities. What we're going to use this framework as we go through this book, so that you can, every time we introduce a new concept, you can look at it in this way. What happens is an accounting system documents activities of a company, and what that does, in the green box to the right of that, you see that it allows you to picture each activity. In other words, that documentation works as a picture of the activity and allows you then to see what that activity was. Number two, the company always receives something and gives something. There was always at least two parts to every transaction, and that allows us to name the items. Your goal is to name the items in that transaction. Remember, there are two or more. Number three, a dollar amount is determined for each exchange, and that's where we can analyze the effects of a transaction by looking at that dollar amount and deciding how that affects the financial statements in terms of dollars. Let's go back to number two again. The company always receives something and gives something. For example, if a company buys inventory, that's an asset. In order to buy inventory, they either have to pay cash, in other words, give up cash, so they're giving cash, or they create an account payable, which is a liability. That is giving something as well. That's giving a promise to pay, a legal promise to pay for that inventory at a future point in time. So now that we have a basic idea of what we mean by financing and investing transactions, we're going to do what we call applied transaction analysis to these transactions. So again, we're going to use this framework, this analyze, record, and summarize framework, to both capture and report the effects of a transaction in the company's records that then get translated into the company's financial statements. A transaction is a business activity. It's something the business does that affects the basic accounting equation. Every transaction is going to have an effect on the company's basic accounting equation, that assets equal liabilities plus owner's equity equation we've been talking about. And at the end of every transaction, every time a transaction's been recorded, that equation is still going to be in balance. Each transaction, as I mentioned in the last slide, has at least two effects on that accounting equation. And remember, every time we record a transaction, that accounting equation is still in balance. So that's the assets equal liabilities plus stockholders' equity. assets must equal the total of liabilities and stockholders' equity after every accounting transaction. And that's kind of the beauty of this double entry bookkeeping system that we use in the accounting world. The company's financial records includes what we call a chart of accounts. This chart of accounts is a list of accounts, all the accounts that we use to analyze the transactions of the company. There will be a number of accounts for assets, a number of accounts for liabilities, a number of accounts for owner's equity, a number of accounts for revenue and expenses, et cetera, et cetera. So we look to that chart of accounts to determine which accounts we need to use to analyze a transaction. So let's take a look at the transaction that would occur when we begin a business and we raise funds by bringing on owners and issuing stock to those owners. What we have here is this company receives $50,000 in cash, in return gives $50,000 in ownership, i.e. stock, to our owners. The assets increase, A, by $50,000, and stockholders' equity under contributed capital increases by $50,000. So you see that duality as we record this transaction. An increase in assets on the left-hand side of the balance sheet equation is equal to the increase in stockholders' equity on the right-hand side of the balance sheet equation. The next step is to invest in equipment. In this case, we invest $42,000 to buy some furniture and other equipment for our business. What we get is we get the asset. We receive the asset in the furniture and the other equipment. What we give is we give cash of $42,000 for that equipment. So we record that as equipment plus $42,000. So our assets under equipment increase $42,000, but our cash under assets decreases by $42,000. So once again, after this transaction, our assets equal our liabilities plus stockholders' equity. Now we also need some money in this particular example to fund our beginning operations and maybe to buy a few other things and all that. So this time we're going to obtain a loan from the bank. What we get is we get cash. In this case, it's $20,000 from a bank that we're taking a loan for, and what we give is we give what we call a promissory note. That's a formal agreement to repay this loan. This particular loan we're saying will be due in 2 years. So let's look at the effects on the balance sheet equation. Cash, which is an asset, increases by $20,000 because we just received $20,000 from the bank, and liabilities, the note payable, which is a liability, also increased by $20,000 because now we have an obligation to repay that $20,000. Again, our balance sheet equation is in balance. So let's look at another transaction. The company purchases $18,000 in equipment by paying $16,000 cash and then promising to pay the rest by the end of the month. That informal promise to pay at the end of the month we call an account payable, and it's a liability because we really do have an obligation to pay that liability. So let's look at the effect on the balance sheet equation. Assets were affected by a decrease in cash of $16,000 and also by the increase in equipment by $18,000. So the net effect is that assets increased by a total of $2,000 net. Liabilities increased by the account payable of $2,000. So once again, at the end of this transaction, our accounting equation remains in balance. Now here's the beginning of another transaction. The company orders cookware, $630 of pans and dishes and other stuff. None of it has been received yet. What's the transaction? Well, the answer is there is no transaction yet. Placing an order doesn't make any difference to us from a balance sheet or a financial statement perspective. It doesn't affect the accounting equation. We do not actually record something until a transaction has taken place. And so once we receive the dishes, pans, whatever, then a transaction has taken place. And we either have we have that asset, and then we also either have a promise to pay, which is a liability, or we pay cash, which is a decrease of an asset. Now, if you remember back to transaction D in the previous slide, that's where we bought some equipment from the supplier and promised to pay $2,000, the remaining balance at the end of the month. When we do that, we give them cash, which settles our debt and reduces that liability. So if you look at the effect on the balance sheet equation, assets decreased by $2,000 and so did accounts payable. So once again, the balance sheet equation remains in balance. Finally, let's take a look at that transaction where we ordered but hadn't yet received the cookware. Okay, now we received the cookware, so transaction actually has taken place. We've gotten the cookware, and in return, we're giving a promise to pay. Okay, so we call that an account payable, again, that promise to pay. So what just happened? Let's look at the balance sheet equation. Our assets went up under the account from our chart of accounts we would call cookware, would increase by $630. On the other side of the balance sheet equation, our liabilities went up, that promise to pay. And again, from our chart of accounts, we would have an account called accounts payable, and that went up by $630 as well. So that's a look at how you analyze the basic everyday transactions that occur in a business. Okay, learning objective 3 has us looking at the bookkeeping aspect of accounting and being introduced to two new terms, journal entry and T account, to show us how, to allow us to explain how different transactions affect the financial statements. Up to this point, our presentation has looked at analyzing transactions. Now we're going to look at recording and summarizing those transactions, and that's where the bookkeeping part comes in. In order to record these transactions, we have to understand what we call debits and credits. Now forget everything you've heard about credits being good and debits being bad. All we're talking about with debits and credits is that a debit appears on the left-hand side of a T account. You can look at the slide here where we show the assets. You have a little account there that we call a T account. It's got a left side and a right side. And then we've got liabilities, a left side and a right side, and stockholders' equity, the left side and a right side. Now every account within these bigger classifications, assets, liabilities, and stockholders' equity, will also have debits and credits. And now what we have to come to understand is how debits and credits increase or decrease these amounts, and that's the bookkeeping part of all of this. Okay, now, if you look at your asset accounts, every account that's considered an asset is increased using a debit and is decreased using a credit. In other words, and when we represent those in T account forms, in other words, that little T-shaped account that you see under the assets label up there, putting something on the left-hand side of that T account is considered a debit and it increases an asset. Putting something on the right-hand side of a T account is considered a credit and it decreases an asset if it's a credit. So debits increase assets, credits decrease assets. Now that debit and credit works just the opposite on the other side of the accounting equation. For liabilities, debits decrease liabilities. So putting something on the left-hand side of that liabilities T account is considered to be a debit, and that decreases the liability. Putting something on the right-hand side of that liabilities T account is considered a credit, and it increases that liability account. And then the same holds for the stockholders' equity account, because it too is on the right-hand side of the accounting equation. You decrease stockholders' equity on the left-hand side of a T account, and that's called a debit. You increase stockholders' equity with the credit, and those are on the right-hand side of the T account. Now it's important again to spend a lot of time looking at this because this debit-credit framework is the fundamental framework of bookkeeping which underlies the record-keeping part of this game that we call accounting. So we use the T accounts that we introduced in the last slide to kind of analyze and demonstrate how transactions are recorded. The way they really get recorded in the records is through this thing we call the general journal, which is pictured on this slide. And what we do in that general journal is we record what we call journal entries I guess, picture or record the transaction that just took place. So once we record a transaction in the general journal, then the third part of our little framework to summarize, all of the transactions are summarized in this thing we call the general ledger. And the general ledger basically has a space for each account, and everything that gets recorded in each account is put into that general ledger, where we then summarize in the form of a balance of each account in the general ledger. Let's go through an example. This particular entry on August 1st, 2010, we accepted cash in the form of contributed capital. In other words, owners or stockholders put some cash into the business. And so we debited cash for $50,000 in the general journal, and we credited contributed capital for $50,000. So in our balance sheet equation, by debiting cash, which is an asset, we increased assets by $50,000. By crediting contributed capital, which is on the right-hand side of the balance sheet equation, we increased contributed capital for $50,000. So assets, $50,000 equals liability plus contributed capital, or stockholders' equity. And so our balance sheet equation remains the same. Now, in the summary process, what we call post each entry from the general journal into the proper account in the general ledger. So that $50,000 of cash that we recorded in the general journal now gets posted under cash in the general ledger. The $50,000 contributed capital that we credited in the general journal now also gets posted as a credit into the general ledger under the account contributed capital. And that's the way we keep records in this bookkeeping game. So to record that transaction we just looked at in the form of a journal entry rather than in T accounts, we would record a journal entry that looks like that one that's highlighted in pink on this slide. We would debit cash for $50,000, and see that plus A means it increases assets. And we would credit contributed capital for $50,000, and that little plus SE means that increases stockholders' equity. So again, our balance sheet equation is in balance. Now let's take a look at this, what we call journal entry, for a second. When we record a debit, it is it's kind of off to the side on the left. So debits are in a straight column, and then credits are indented to the right. And so if we've got two columns, if you imagine this journal entry as two columns, debits are in the left column, credits are in the right column, and the account titles we're working with, debits would be further to the left, and credits would be indented. The account titles to the debits would be indented to the right as well, just to help us read through these journal entries and understand what's going on. Now, the only difference on this slide from the previous is that if you look down at the general ledger, you see the little red lines that have been added to signify what or represent these things as T accounts. So remember when I said every account can be represented as a separate little T account? Well, cash in the general ledger would look like this T account, where now we have a debit, $50,000 on the left side of the T account. On the other side of the accounting equation, we've got contributed capital that would come under stockholders' equity. Therefore, it increases with the credit on the right-hand side of the T account. And so that credit for $50,000 for contributed capital would appear on the right-hand side of our T account. And if you were to record transactions A through G that we looked at in previous slides, you can see that the T accounts would look like what this slide represents. In other words, transaction A is when we receive $50,000 cash in exchange for ownership or contributed capital. You can trace the A, $50,000, a debit to cash, which increases cash because it's an asset. And then look down at the lower right-hand side there for the other side of the transaction of A, and it shows an increase to contributed capital. Contributed capital is on the right-hand side of the balance sheet equation. So it is increased by putting a number in the right-hand side of the T account, which represents a credit. So you increase an asset with a debit on the left-hand side of the T account for the asset, or left-hand side of a journal entry, and you increase contributed capital with a credit because it's on the right-hand side of the accounting equation, and it would be indented and off to the right in a journal entry. Now, take a look at all of those transactions and get a feel for how they were recorded and represented here in these T accounts. Now we're going to learn about preparing a classified balance sheet. By classified, we mean we're going to arrange the assets in terms of short-term and long-term. We're going to arrange the liabilities in terms of short-term and long-term. So we're classifying our assets and liabilities in terms of whether or not they're short-term or long-term. Now, before we go about preparing financial statements, it's always a good idea to use that double entry bookkeeping concept to make sure that at least our debits equal our credits. And that's the way this whole bookkeeping game works. You have the same amount of debits as credits in every transaction. And of course, the cumulative effect then for a period of time is that all of your debits have to equal all of your credits. So we do what we call a trial balance. We list out all of our accounts from the very first account all the way through the last account. That's and we call that a trial balance. Then we put the debits in a left-hand column and the credits in the right-hand column. We add them up and they ought to equal. If they don't equal, something's out of balance. We made an error someplace and we have to go back and find it. So then we transfer the amounts. By transfer, I mean we use the amounts in that trial balance to prepare our financial statements. For this balance sheet, that means we have to know which of those accounts in that trial balance we need to include in the balance sheet, and we prepare a balance sheet. Now I want you to take a look at the heading, that little pink area at the top of this balance sheet. It has three things that are really important, and unfortunately there's a typo here, but take a look anyway. It has the company name, it has the financial statement name under that. This slide says balance, it really should say balance sheet. And then for the balance sheet, it has a specific date at August 31st, 2010. What that specific date tells us is that on that date, at the end of August 31, 2010, these were the balances in our asset, liabilities, and equity accounts. So we look at the balances as of those days. Now when we get to the income statement and the statement of cash flows, and even the statement of retained earnings, we're going to be looking at those statements over a period of time. So that date line will define the period of time that that financial statement relates to. But a balance sheet refers to a very specific point in time, in this case August 31st, 2010. Now the other important concept on this slide is that, as I mentioned, we are going to classify our assets and liabilities in terms of whether they are current or long-term. And current assets are assets that will be used up or converted to cash within the next 12 months. A long-term asset includes resources that will be used to turn into cash more than 12 months after the balance sheet date. And so property, plant, and equipment, that's $60,000 of assets that we bought. We hope and intend that those are going to be used and last more than a year, and so they are considered long-term assets. You can see that they are classified separately here. The cookware, we figure, well, you know, in a restaurant, you go through cookware, you wear it out quite often. And the cookware we buy, we don't expect to last more than 12 months. That's why it's classified as a current asset. Cash is already cash, and it's current. It can be used at any time. So we consider that a current asset as well. Finally, as a user of these financial statements, we ought to be able to take a look at this balance sheet and interpret it somehow, use some tools to get a feel for how well this business is performing. One of those very basic tools is what we call the current ratio. The current ratio is current assets divided by current liabilities. In this case, the company has $10,630 of current assets and only $630 of current liabilities, for a current ratio of 16.9. That means that the company has $16.9 of current assets for every dollar of current liabilities. A higher current ratio means that the company is in a better position to pay off its current liabilities. And this is an unusually high current ratio, that's 16.9. Usually, we even consider a current ratio of $2 of current assets to every $1 of current liabilities to be pretty healthy. So this particular current ratio is very high. Now, just a point, as you think about these analytical tools like current ratio, for example, it's nice to know and very good to know that the current ratio equals current assets and current liabilities. If you're trying to understand this company, you would also want to take a further step to take a look at those current assets, what's in there, take a look at those current liabilities and see what's in there as well. So you get a little better feel for what this company is all about. So what actually gets recorded on a balance sheet and in the accounting records? Well, any item that we acquired for something of value that can be measured gets included in the accounting records. And when we say items acquired through exchange, we mean if you exchange cash for an item, or if you exchange promise to pay for an item, or even something else of value. You have to be able to determine that value for what you acquired, and then that gets included in that financial statement as well. What does not get recorded? In this particular case, like if you have a secret recipe that you developed on your own or any of those types of things, those aren't recorded because it's very subjective as to how you would go about placing a value on something like that. So what amounts to record things? Well, everything is initially recorded at the cost of what we exchanged in order to acquire that particular asset. Okay, so, and we have this principle we call conservatism in accounting. What that really means is, who are we showing these financial statements to? They are people who are going to make a decision that affects them financially. And so if we're going to record, if there's some question about the value and it's a real value, and we have a choice between, kind of an equal probability between a little bit lower value and a little bit higher value, we will always choose the lower value to record that asset or that transaction at, because that is where we are going to cause the least harm for an investor or a creditor. Now, if we have asset values that have actually declined in value once they've appeared in our records, and that decline looks fairly permanent, we are going to record that decline in value. Okay, so that's the end of the audio slides for this particular chapter, for Chapter 2. Now, go ahead and take a look. This presentation also includes some solved exercises from the chapter. So if you look at your text, you can reference those exercises and then go ahead and look at the solutions to make sure that you understand how to go about what we just talked about. Good luck with Chapter 2.